Fixed versus variable mortgage rate. Should you lock into a fixed rate for peace of mind or go variable and hope to save money as rates change? Over the next 11 minutes, I'm going to explore the thought process that you should undertake when making this important financial decision. Let's set the scene with some quick facts. As of spring 2025, mortgage rates have settled down a lot from the heights of what we saw in 2022 and 2023. For a 5-year fixed rate mortgage, you're looking at interest rates in the low 4% range. This is also true for variable rate mortgages. Why are they so close? Over the last year, the Bank of Canada has cut its overnight interest rate several times as inflation stabilized, bringing it down to about 2.75%. This means that the prime rate at banks, which variable rate mortgages are based on, is now roughly 4.95%. With lenders typically including the discount off of prime for variable mortgage rates, new variable rates end up just above 4%, similar to fixed rates. Meanwhile, fixed rates have also come down from their peak because Canadian bond yields, which influenced fixed rate mortgages, eased in the second half of 2024. The bottom line is today's rates are much more borrower friendly than they were a year ago, but choosing between fixed or variable isn't just about the rate today, it's also about where rates might go tomorrow. Predicting the future is never a sure thing, but we do have some clues of where things are headed. The Bank of Canada hit the pause button in April and June this year, holding its key rate at 2.75% after a series of cuts. We've basically reached what economists call a neutral rate, a level that's not heating up the economy but not slowing it down either. Now, a big question is whether the Bank of Canada will cut rates further, keep them steady, or even hike them again if inflation flares up. Many experts believe we'll see stable or slightly lower variable rates as we go through 2025. Why? The economy has shown signs of cooling and inflation is mostly under control. Some forecasts predict the Bank of Canada could trim its overnight rate a bit more, bringing it down to around 2.25% by later in 2025 if the economy needs a boost. In practical terms, that could mean a prime rate at the bank closer to 4.5%, down from its current 4.95%, which would lower variable mortgage rates further. In fact, financial markets are already pricing in at least another 0.5% cut over the coming months. On the flip side, we can't ignore the risk that rates could also hold steady or tick back up if inflation surprises on the upside or economic shocks come along. The Bank of Canada could decide to pause cuts or even hike rates to keep prices stable. Safety, stability, and peace of mind. Let's move to the other side of the fence. Choosing a fixed rate mortgage is all about certainty. You can lock in your interest rate for the term, often 5 years, and your monthly payment stays exactly the same. In these uncertain times, that stability can be a huge relief after the wild rate swings we saw recently. A lot of Canadians just want to set it and forget it with a fixed rate. You won't need to worry about what the Bank of Canada is doing every few months. Your rate is guaranteed not to change. That means easier budgeting and no surprises. There's a reason why the majority of Canadians have been leaning toward fixed rate mortgages. In fact, nearly 80% of mortgage shoppers went with fixed rates in 2023. Why? Because fixed rates offered peace of mind. Even if a fixed rate is a tad higher than a variable rate at the start, many people are willing to pay a little extra for the security. It's like paying for insurance. You're protecting yourself against the risk of future rate hikes. And considering that in early 2023, fixed rates were much higher, locking in a 5-year fixed at today's rates can feel like a win. Now, fixed rates aren't perfect for every situation. Keep in mind that if interest rates fall further, a fixed rate borrower won't benefit. You're locked in. And if you need to break your mortgage early, say you sell your home or you refinance early, fixed mortgages can carry steep penalties for breaking them, especially at lenders who charge these penalties off of posted rates. But overall, if you value certainty and stability, a fixed mortgage is the option that lets you breathe easier. So fixed rates give stability, but what about variables? Let's talk about the potential upside of going variable and why some borrowers are still drawn to it, especially if they expect to save money over time. Opting for a variable rate mortgage is a bit like riding a wave. Your rate can go up or down during your term because it's tied to the Bank of Canada's moves. The big appeal here is the potential savings in the long run. Historically, Canadians who chose a variable rate have often paid less interest overall than those who went fixed. If rates drop after you sign your mortgage, and as we discussed, there is a decent chance of some small cuts in the next couple of years, a variable rate holder will see their interest rate and possibly payment go down automatically. You're not stuck waiting until the end of a term. You get the benefit as soon as the prime rate falls. Even today, some experts believe that going variable could save you more over the next few years. For instance, mortgage analyst Dave LaRocque notes that if a fluctuating rate won't put you under financial strain and you're comfortable with uncertainty, the variable rate will likely turn out cheapest in the end. Another advantage of the variable mortgage is flexibility. Life happens, jobs change, families grow, opportunities come up. If you might need to sell your home or refinance before your 5-year term is done, a variable mortgage can be easier and cheaper to get out of. Why? Well, the penalties for breaking a variable rate mortgage are generally limited to about 3 months interest, whereas breaking a fixed rate mortgage can sometimes cost thousands of interest penalties. For example, if you're an investor or you think you might upgrade to a different home in a couple of years, leaning variable could save you a hefty fee when you make that move. Of course, choosing variable means accepting some risk. Your rate can increase if the economy takes an unexpected turn and the Bank of Canada hikes rates. So let's talk about how to decide if you personally are a good fit for a variable or a fixed. Every borrower is unique, but here's a general way to look at choosing fixed versus variable. Ask yourself, what type of person am I when it comes to finances? If you value security and hate surprises, a fixed rate is probably your best bet. This tends to be true for first-time homebuyers, young families, or those on a tight budget. If you know that even a $100 increase in your mortgage payment would stress your budget, the safety of a fixed rate is where you're going to want to be. You'll know exactly what you owe each month, and you can set your household budget without fear of a sudden spike. Fixed is best for those who prioritize peace of mind and predictability. On the other hand, who is a variable rate best for? Typically, it's folks who are a bit more financially flexible and comfortable with taking on some risk in exchange for potential reward. This might include seasoned homeowners or investors who have seen interest rates cycle up and down before, or anyone who has a decent cushion in their budget. If you have a stable income, some savings, and the temperament to handle it if rates bob up and down, you could be a good candidate for a variable rate. You might even benefit significantly if rates do indeed fall over the next few years. Your cost of borrowing would drop. Also, as we mentioned, if you suspect you'll move, sell, or refinance in the midterm, the variable's lighter penalty structure could be beneficial. So here's your homework. Think about your 5-year plan. Are you planning to stay put in your home and play it safe, or do you foresee changes and want maximum flexibility? At the end of the day, choosing fixed versus variable is as much an emotional decision as a financial one. Know your risk tolerance. Be honest. How would you feel if your mortgage rate rose by 0.5% or 1%? If the thought makes your heart race, or if your budget is so tight that a rate hike would force painful cutbacks, that's a strong sign you'd be happier with a fixed rate. There is absolutely nothing wrong with paying a bit more in interest for the peace of mind that your payment won't suddenly jump. Conversely, if you have stable finances and a bit of financial buffer and you don't lose sleep over the market fluctuating, then you might lean towards variable. You need to be comfortable with a degree of uncertainty, and remember, even with a variable rate mortgage, you can often structure your payments to manage risk. For instance, some people set their payments as if their rate was higher, so they pay extra principal when rates are low and are prepared if rates rise. That kind of strategy requires discipline, but can take some of the sting out of the potential rate increases. The key is cash flow stability. If a bump in interest rates would jeopardize your ability to pay bills or save for the future, play it safe with a fixed. If you've got room to maneuver, variable could be a calculated risk that pays off. It's really about knowing yourself. So to recap, fixed rates offer stability and peace of mind. You trade the chance of saving a bit for the guarantee that your rate won't rise. In a climate where fixed and variable rates are nearly the same, that certainty is very attractive, especially if you're risk averse or on a tight budget. On the other hand, variable rates offer flexibility and potential long-term savings. If rates fall, you benefit, and you have lower penalties if you need to make a change midterm. But with the variable, you need to be able to handle the possibility of ups and downs. If you're still unsure, talk it through with a mortgage professional. Feel free to reach out to me or drop a comment. I'm happy to help you figure out what's best for your circumstances. Make the right call on this, and it can make a huge difference in your financial peace and stability. If you found this video helpful, give it a thumbs up and consider subscribing for more down-to-earth mortgage advice. If you'd like to learn more about a mortgage renewal strategy that combines stability with flexibility, click right here.